So there are a couple really big trends to be aware of from the macro perspective. And so one of the biggest ones is the dollar cycle. And so ever since early 1970s, since the Bretton Woods system ended, we've had this system of floating exchange rates where, instead of the dollar being pegged to gold and all these other currencies being pegged to the dollar, we have the dollar floating against a basket and other currencies floating against each other as well. But the dollar is the most important one because it's the global reserve currency, and so that's historically meant a couple things. One is almost all energy worldwide until very recently has been priced in the dollar, and so even if Saudi Arabia sells oil to France, they sell it in dollars, and so that means that every country in the world that needs oil needs dollars, and so they either sell some of their goods and services in dollars, or they trade their currency for dollars, and so there's that, and then two, you start to see that countries get dollar-based loans or issue dollar-based bonds. And so, for example, you have a company in China issuing dollar-denominated bonds, even though the dollar is, of course, not their domestic currency. And so you don't see American companies doing that. You don't really see Japanese, European companies doing that, but the rest of the world heavily does that. And then even there, it's not like all of those are then owed to Americans. I think that's a big misconception, is that because they're issuing dollar-based debt, that's owed to Americans, but that's actually not the case. They're often owed to Europeans. They're often owed to Japan. So you have a case of like a company in Japan making dollar-based loans to a company in say Africa, and so it's a very unique situation. And if anything, China's been a really big lender in dollars to a lot of frontier markets throughout Africa and Latin America, places like that. And so you have the situation where if they all borrow when the dollar is weak, and then the dollar strengthens for one reason or another, a lot of those emerging markets run into trouble because the debt that those companies have relative to their local currency cash flows goes up, and so that can be a big problem and result in insolvency, and in some cases the governments themselves become insolvent. And so we see these really big kind of 15-year cycles for the dollar. And so the dollar had this big spike in the mid 80s. It had another big spike in the late 90s, early 2000s. And then ever since 2015, we've been in the third major dollar spike. And so if you look at the dollar over time, it's kind of like this big sine wave that goes up for like 7 years, goes down for 7 years, and you have these really big cycles. And those are tied to major shifts in U.S. fiscal monetary policy, but they have kind of global implications because of that big liquidity dynamic. And so normally during these weaker dollar periods, you get kind of a global boom. You usually get a commodity, a bullish cycle for commodities. And then on the other side of that, whenever the dollar strengthens, you usually get a slower period for growth, a more disinflationary environment, more of a commodity bear market. And then ironically, a lot of people think that a strong currency necessarily benefits that country. But for example, if you look at U.S. corporate profits, they flatline for multiple years every time the dollar gets strong. And it generally makes our trade deficits blow out, even more than they already are kind of as a baseline. And so it's kind of been this interesting dynamic where, whenever the dollar gets too strong, it hurt, for these weaker countries break first, the ones that have a lot of dollar-based debts relative to their FX reserves, but then that trickles throughout the entire world, including back to the United States. And then it usually forces the United States to, shift to a more dovish monetary policy, more dovish fiscal policy, and then that alleviates the dollar, and we kind of start the next down leg of that cycle and that kind of next outlook. And so, really kind of paying attention to the dollar cycles and, what things are overvalued. So any sort of trend naturally kind of goes too far. And so when you have a really disinflationary environment, investors pile into safe bonds, they pile into growth stocks, they pile into all these things, and they will get the valuations very high. On the other side of the spectrum, when you have a weaker dollar, when you have a boom, you'll have investors pile into commodities and emerging markets and things like that, and make their valuations too stretched, and assume it's going to go on forever. And so, in 2000, for example, we had the dot-com bubble, and then in 2007, 7 years later, we had emerging markets that were roughly as expensive as some of the dot-com stocks were. We have, if you looked at the CAPE ratios, the cyclically adjusted price to earnings ratios of China or India, they got pretty silly in 2007, and so it's no wonder that they've had this really big bear market, in especially in dollar terms. And so basically knowing where we are in this dollar cycle, and then kind of looking at valuations of growth stocks, value stocks, and commodities, and kind of looking for these trend shifts is kind of a big part of my framework. And then so overall, I view us kind of entering most likely one of those weaker dollar periods, higher commodity prices, but the potential for international equities to outperform U.S. equities, potential for value stocks to outperform growth stocks. And so, starting from that framework, I've then kind of go around to different countries, including the U.S., and find some of the best plays for that. And so, one of the troubles with commodity stocks is that because they're very boom bust, they're very aggressive. They're not necessarily good long-term investments. They're more like a trading vehicle in some cases. Whereas, for example, some of those Japanese trading companies, because they have some of those other stable cash flows as a ballast, they actually can be long-term compounders if they're managed well. And so that's kind of a more buy and hold way to express a diversified, pro-industrial, pro-commodities period of time. And so that's one example. Same thing if you look at the Russian equities, you can say, okay, if we're going to have a decent commodity environment, if we're going to have potentially a weaker dollar, what do some of these companies, how are they likely to benefit from that, especially if they have pretty low debt, they have very low valuations, they're actually in many cases managed pretty well, and it kind of goes go down the list and find things that can either benefit from that reflationary trend or that pro commodity trend, without necessarily going into some of the more aggressive things that are really kind of boom bust in nature.